Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Once a month, I give the twin webinar entitled Tracking Live the Forex Market Together, Part 1 and Part 2. For this month, today I am giving the webinar Part 1 between 8 and 10:20 GMT and Part 2 from 13 to 13:50 GMT. So basically, during this particular webinar time, I wish to make it more interactive, and I want the participant to ask questions while I'm taking the positions and why I'm taking the positions in such direction, either on the sell side or on the buy side. Then later on, what happens to that of the trade. So we will try to correlate the forecast with that of the market reading and try to take the live positions and see the result during the part 2 of the webinar, so that you'll be able to understand it is a simple live market tracking technique which helps us to earn money from that of the market. So basically, our market reading should be a very simple methodology so that we can quickly understand what is happening in the market, and accordingly we can take positions without any ambiguity. And we should also have equally the effective trading strategy. Thereby, we will be able to limit the risk and maximize the profit. Because in trading, we go in for a leverage trade. So when you take more position beyond our capacity, we only pay a margin to hold the position. In such a situation, our margin should not be exploited. If it is exploited, then automatically you find the fear grips in. So in order to avoid all such complications, we need to use the effective trading strategy to limit the risk, so that at a given time, we will take only a calculated risk and we will not be taking a position with open risk factor. Then we aim to earn consistently from the market. It is not in 1 or 2 trades and lose some trade and earn in 2-3 trades and again lose in 2-3 trades. That sort of taking chances with the market will not work in the long run. And if you watch carefully such type of traders, they will be in the level where they have started. So they would have earned about 10-15 trades and lost in 10-15 trades, and ultimately they will be staying in the same place. The only satisfaction they will have is that they have been occupied by looking into the other market and trading, but no benefit is reaped. So we need to understand that we are coming to that other market in order to earn profit. Thereby, we will be able to improve our lifestyle with the help of the extra income. Then that should not become a trap and drain our income from elsewhere. So if you have the regular income and in the process of trading, we should not lose that. So once you lose, what will happen? Then you struggle for your day-to-day expenses. That is why when you are opening trading account, in the trading platform, they give a mandatory statement for you to check that in the event if you lose the money, what you have deposited as equity, your lifestyle will not be altered. That means you are not borrowing that money and depositing it for trading. But many of the traders, they use the credit card and borrow the money, but still they check the statement that their lifestyle will not be affected. But once they lose the money, they really struggle hard. They fight with it of the platform providers. But We have to understand that all the platform providers can earn money only from that of their own clients. So if they are capable of trading on their own and earning money, then they won't be offering the trading platforms. So when they are not capable of earning money by trading, then they go in for the provision of trading platform. So we have to understand such people can earn money only from their clients. In this situation, they will try to play some trick with it of their clients and try to earn from clients. So this is what happens in the market. So we need to understand how we have to handle such issues during our trades. So first of all, let us see how exactly our trading will be. Then I will also explain to you the forecast for this week. Because on Monday, due to some technical reason, we are not in a position to provide the Asian session live market analysis webinar. So I have not given the forecast for the entire week so far. Today we are on Wednesday. Doesn't matter, better late than never. So I thought that I can make use of this time and give you the forecast as well, and also explain to you the range in which the currencies are expected to swing in this particular week. Then afterwards, I will take the positions following the derived forecast, market reading to fine-tune the forecast, and use the trading strategy to limit the risk. So that I will explain to you. So basically, my forecast follows a time frame. The time frame followed by that of the players. So the players have divided based on certain geophysical positioning of various countries, have divided the entire 24 hours market cycle as the 3 sessions based on the opening and the closing of the banks. They are namely the Japanese session, European, and the US session. So each session has got a time frame. Since it is a continuum, it is better to follow that time using the GMT scale. So Greenwich Meridian time, we will use it. 0030 to 7:30 is the Japanese session. 7:30 to 8 GMT is the gap time before the start of the European session. 8 to 13 GMT is the European session. So today by 8 GMT, we have started our webinar, and it will go up to that of 10:20 GMT. Then by 13 GMT, I will come back. 13 to 13:30 GMT will be the gap time. The players are expected to make a false move before that of the intentional move. Then we will watch for about 15 minutes or 20 minutes of the US session and see how the position goes. Then afterwards, the US session gets over by 20:30 GMT. Then 20:30 to 0030 GMT is the gap time before the start of the next day. So this is how the market timings are being framed based on the bank opening and the closing. Why we need to follow it? Because the forecast says that the market follows these timings. So the early, mid, and the late sessions, how they are going to make the move. Suppose the early session, they will make a dip, then slowly mid session and the late session, they will gain the level. Early session, if they gain and make an upward stop, and then European session, they will make the slide and hit, and things like that. So we need to understand from which time to which time they are going to make specific moves. Let me show you the forecast part of it. Okay, this is the forecast slide for this particular week. Already 15th and 16th are over. We have seen how exactly the market is making the slide and firm up, etc. Today we are on 17th of May. The market made the dip during early part of the Japanese session, started making the rise, and they are expected to make the swing and slide move during that of the European session. So make an upward stop and then drop. So already they have done the upward stop in the case of Euro and also in the case of GBP. Slowly they are expected to slide, and during that of the European US session, they are expected to make the swing in the middle level and continue to drop. Then tomorrow, Thursday, they are expected to make a dip and firm up during that of the Japanese session, and then high level swing and slide during that of the European session, and swing and firm up during that of the US session. Then on 19th May, I'll give the Asian session webinar at that time. They are expected to make the swing and firm up during that of the Japanese session, then rise again during that of the European session and drop towards the close of the US session. So here you will come across, now kindly refresh, you will be able to see the video. Then the expected market moves for this week is being given, and kindly take a screen print or screenshot, or you can just make a note of it and use it on a daily basis. And the session timings are given here. So Japanese session, European, and the US session. So each session, how they are expected to make the move. We'll be able to really follow that. They make the swing, they make the dip and rise. Then afterwards, when this new session start, they will make the swing and slide. And the next session start, then they will make the swing and again make a drop. So you'll be able to really understand how they strictly follow these timings. That is why I keep the window showing the GMT time frame. This is nothing but the my homepage in my website, iknowindices.com, and there you come across in this page, the GMT time is mentioned. I just magnified the screen, but in the normal screen, it will be small. Okay, it will be like this. And here you find the GMT time as well as your local time. So easily you can understand how your local time is away from that of the GMT time frame. So that you can make use of it and just watch the GMT time frame alone and try to understand how the players are trying to make the moves in the market. So it is 8:15 GMT. That means 30 minutes or 45 minutes from the start of the European session. By end of the European session, the slide is expected to happen in the Euro and GBP. So we should aim to do sell and buy trade. Then the levels in which the currencies are expected to swing in this week, I just given it here. We have seen that the high they are supposed to reach was 1.1075. It has gone up to that of 1.1122 now, and then started making the slide, and it could come across towards close of the week. They started making the drop. In the case of GBP again, they started gaining up to that of 1.2957, and they're expected to go a little higher and start making the drop again. Then in the case of yen, they made the higher level consolidation and they are expected to make the drop again and again. You can see that new lows are formed. Then similarly in the case of CHF, they've gone up to that of 0.9975 and above and parity briefly and come down to 98.26, and then slowly they are coming down to that 98 area. In the case of Canadian dollar, they went up to that of 37.22 and started coming down now. Then in the case of Australian dollar, near that of 0.74, they consolidated and started gaining the levels. So in all, you come across that they are making mixed moves. It might appear that against that euro, USD yen are making US dollar weakening move. But as far as GBP is concerned, it is making sideways move. And in the case of CHF alone, CHF also, it is making only sideways move, making a swing for about 100 pips. And in the case of Canadian dollar, it is making USD weakening move, and Australian dollar also showing the USD weakening move. But in all, if you watch that they mix a little bit of USD weakening move and again start making USD gaining move. What is happening with regard to the players? They are making the middle level consolidation with either way stop and moves. That is what happening. After that, of the extreme lows, what they have shown the beginning of the year, they have just started making the gain and passed through that of the highest level of the lower level consolidation, gone to that of the middle level, started making the either way swings. What they do is they accumulate positions near that of the low during the lower level consolidation, start gaining the level and hold high and building profit, book profit by offloading their buy positions. Then they have to build sell positions. That is why you find that they are holding for a prolonged period in these levels. So they make a nominal gain either in the case of euro nor in the case of GBP, just to handle the euro GBP cross, as well hold high and build sell position. But if you look into that of the market, it will appear that every day it is gaining. So market is bullish. That is how you will feel. And those who have gone short will go in for short covering. So what they do, they would have taken a lower level sell. They will come and buy it at the highest level. Then afterwards, the players sell it to them and induce the traders to develop the bullish feel and induce them to accumulate buy positions. Then they are expected to make the slide and induce them to liquidate their long position of what they are taken at the higher level, and thereby you find the players book profit of what they have accumulated during the lower level consolidation, and then after booking profit, let the market to fall freely and start accumulating at the lower level. But they don't go to that of the extreme low. They will come to that of the middle level, the lower part of the middle level consolidation, and afterwards they will try to gain the levels again in order to do 2-3 times the churning, buy low and book profit at a higher level, then build a sell position, drop the market and buy low and gain the level and book profit. So this they may do it for about 100 to 200 pips, and then once the profit is built up, and that will be used to buy at a higher level and rise the market, so that their average buy level will be still lower than that of the market. So this is the strategy from time immemorial. The players are using it in order to see that any time in the event of a natural calamity or something like that, they should be able to exit of the market without any constraint, without losing much in the market. So that is why they build profit, and with the help of the profit, they try to rig the market and gain the levels, so that they are able to gain the level and book profit again of the lower level buys what they have done at further higher level. So normally they have the shift in trading zone, lower level consolidation with a frequent downward stop, and then rise to the middle level of the market, then middle level consolidation with either way stop ends. That is what they are doing it now. Then they will gain the levels to the higher level and make higher level consolidation with frequent upward stop end. So with the help of the identification of the stop and moves, we'll be able to really understand what level they are doing the consolidations. So I have given the levels in which they are making the consolidation here. You can make a note of it, and that will be used for our understanding. Now, let me explain to you the trading system. What we do is we just open the live market code page. This is the link for the same. You can just copy and use it to open it in a browser. And then also note down, it shows the 6 pairs, namely the 4 majors and 2 commodity pairs. The majors are Euro, Yen, GBP and CHF, and commodity pairs, namely Canadian dollar and Australian dollar. They can be in the numerator or in the denominator of a ratio. So wherever the currency is in the ratio of US dollar, they are called majors. Then these 2 pairs, their activity or moves depending upon the pricing of the commodities, and that is why they are called as the commodity pairs, because their currency movement is primarily based on the export of the commodities. In the case of Canadian dollar crude, and in the case of Australian dollar gold. Then if the currencies are trading against each other, like Euro Yen, then Euro GBP, Euro CHF, Australian dollar Yen, GBP Yen, they are all referred as crosses, wherein US dollar is not involved. Many traders are of the opinion, since US dollar is not involved, so we can use easily the technicals and understand the market moves and take positions. But invariably, the players, what they do is they make big moves in the case of the majors, and thereby they just bring in the movement in the case of the crosses. So what they do is they make the USD gaining move or the USD weakening move. And also in some pairs USD gaining move and certain other pairs USD weakening move, and that is referred as a contrarian move. At the moment they are doing the contrarian move, let me show to you. Now Euro and GBP are showing positive net change. So that means they are gained the level. So when they are gained the level, US dollar has become weak against them. So Euro and GBP are showing USD weakening move. Then USD Yen and USD CHF, they are showing negative net change. So when they are showing negative net change, that means Yen and CHF have become stronger than that of US dollar. So again, it is USD weakening move. So all the 4 majors are showing USD weakening move. But look at that of the commodity pairs. USD CAD, wherein Canadian dollar is in the denominator position, and when it shows positive net change, that means it is gaining. That is, US dollar is gaining against it. Now it is showing 1 pip negative. That means Canadian dollar is gaining. And Australian dollar, even though it is a numerator currency like Euro and GBP, it is showing negative net change. When Euro and GBP are showing positive net change, Australian dollar is showing negative net change. So which is a contrarian move. So you have to understand why they are making such contrarian moves. When they make such contrarian moves, you find that their respective commodity pairs are being handled during that of the mid sessions. So now they are handling Euro, Aussie, GBP, Aussie, etc. Thereby you find the contrarian move is happening. When Australian dollar shows negative net change against US dollar, when Euro is showing positive net change against US dollar. So Euro Aussie across, wherein denominator is weak and the numerator is strong, so it will show positive net change. I'll show you that. Euro Aussie. See here. Euro Aussie, they are showing 54 pips positive net change by making a contrarian move. Then similarly, GBP Aussie, which is showing about 72 pips positive net change. Because GBP is showing positive net change, Australian dollar, which is in denominator, showing negative net change. So that means Australian dollar is much weaker when compared to GBP or Euro. So they are showing positive net change. So this is how the players make moves in those crosses. So we need to understand what cross they are handling at a given time by looking into it. And then if you take positions accordingly, you'll be able to make good profit in the cross trades. Otherwise, if you simply follow technicals and take positions, sometimes you might see the profit, and most of the time you will be trapped. Because in the case of crosses, what the players do is during the mid sessions they handle the crosses. So during the mid sessions, when the volume is relatively less, they try to make big moves in the case of crosses. So at that time, you should try to take a position or close position. Then you will be really benefited out of the market moves. So in the live market code page, what we do is we note down the high, low, and the net change in all four majors and two commodity pairs around 3:30 GMT. And they are referred as the initial lows and the highs, which is for the market reading technique. Then afterwards, the net change indicate the current market level from that of the previous day US session close. So here, when Euro shows about 7 pips positive net change, that means from that of yesterday US session close, Euro shows about 7 pips higher level now. GBP is showing 63 pips negative net change. It means from that of yesterday US session close level, USDN has made the drop of 63% pips. So this is how the net change indicate where the market is when compared to that of the previous day close. So when the market is near the low and the low is not been breached for more than 30 minutes, we can try to take a buy during the start of the session and book profit during the rise. So we try to do the market reading by recognizing, noting down the initial lows and the highs around 3:30 GMT. So only when they are near the low or near the high, we will try to enter into a trade. If they are in the middle level, we watch for that market to move either towards that of the high or towards that of the low before committing a position. Now in the market reading, okay, I noted down around 3:30 GMT today the initial lows and the highs. Euro formed the low 1.1080 as the low, 1.1115 is the high. Then subsequently they went up another 7 pips to 1.1122 and come below that of 1.1115. It is closer to that of low. So what they are expected to do? The forecast says that they are expected to make a swing and slide move. Let us see, because our market reading also shows that they made a brief upward stop and then started holding it closer to that of the low in order to go further lower. In the case of GBP, 1.2912 was the initial low. They just made a brief downward stop into 1.2906 and come above that of 1.2912, and 1.392942 was the 3.1 was the high what they set around 3:30 GMT, but they went up to 4.2 as an upward stop, and during start of the European session started coming down below 29.31. Now it is 29.25, 27. So that means they wanted to make a slide. After making a brief downward stop and followed by upward stop, and they are holding in the middle level to make a drop. Then in the case of yen, 112.43 was the initial low, 113.13 was the initial high. The initial high they are not breached it, but initial low they have breached it. 112.43 came down to 112.26 and holding above that of 112.43. They just made a brief downward stop and start holding above that of the initial high, indicating that they will make some swings here. When Euro and GBP are making the slide, USDN is expected to make the gain. Later on, they will just make the slide in the case of USDN also, in order to make contrarian move of downward move in the case of Euro GBP as well as USDN. As a result, Euro Yen and GBP Yen crosses, they will make downward move as a contrarian move. In the case of CHF, 98.26 is the low. They just breached the low and came down to 98.20, and 98.68 is the high, which is intact. So slowly they are breaching the low, and which has come above that of the initial low. So they made a brief downward stop and started gaining the level and make upward stop and afterwards. Then Canadian dollar. 1.3604 is the initial low. They breached the initial low, came down to 1.3579 and come above that of the initial low, 1.3604, and now it is 1.3610 level, and 1.3618 is the high that they breached and came up to that of 1.3629 and come down. So they have made the either way stop, and one above that of the high, then came down and just below that of the low, and now they have come above that of the initial low. So either way stoppings, they are making it. Without losing much of the levels, they are trying to build sell positions. Then Australian dollar, 74.11 is the low. They breached it and came down to 73.97. Then holding below that. So they intend to make further downward move in the case of Australian dollar. Then 74.32 is the high which has not been breached. So here you find in the market reading, they intend to make the US dollar gaining move during this particular session. So in such a situation, what we should do? We need to find out what sort of moves they have done it. I'll explain to you after taking the positions. I'll just go to that of the edit mode and take positions. So we will take sell position in the case of Euro. The high is 1.1122. So we'll keep closer to that high, a level 1.1119, 5 pips below that, so that we'll get a definite fill, which is only a order. It is sell limit order 1.1119, and exit will be near that of the low. So when it is near that of the low 1.1080, they are not breached it. So most likely they are expected to breach the level. We'll keep it 1.1060 by keeping it 20 pips below that of the initial low. Then we'll have to keep a buy stop as the hedge order. 1.1149. 30 pips above that of the entry level will keep the buy stop. Similarly, in the case of GBP, we'll try to take the sell position, sell limit 1.29. 42 is the high. We'll keep it as 38, just 2-3 pips below that of the initial high, because they may not reach up to that level. That is why they will just firm up in order to induce the traders to place buy orders and dump the positions. Then exit. The low is 1.2906. We'll try to keep pips below that of the low, a buy limit order. Then for that of the sell limit, we'll keep the buy stop as the hedge. That will be 30 pips above 1.2958. Then in the case of yen, they just breached the initial high, initial low, and come above that of the initial low. So 112.45 they are holding it. So we'll take a buy position, buy limit order. $112.30, just close it to that of the low. We'll keep a buy limit order, and take profit will be 113.10, closer to that of the high. Then for that we need to keep a sell stop. $112. Aussie, they are expected to make a drop, so it will be a very sluggish move. So let us not take any position. So these are all the 3 recommended trades. Near that of the high, we'll try to take a sell position in euro. Near that of the high, we'll try to take a sell position in GBP, and near that of the initial low, we'll try to take a buy position in the case of USDN. These are all the 3 trades. I just kept the limit orders. Still, they are not become trade. They are only orders. Once they are filled, they'll become positions, and then I will track the positions and show you. You can also track the position and discuss with me once we have completed the trade, and discuss about it during our second part of the webinar. If you have got any question regarding these decisions, you can ask me in the question answer window. In FX Trade Forex live video window, I'll be willing to answer those questions for you, so that it will be more of interactive. I'm just doing this mainly for those who are new to that of the Forex, and those who have been doing Forex trading for a long time but not seen the success. Then for such people, I wanted to guide them by giving the free forecast and also the free trading strategy, which you can follow and try to build up your equity. Now we'll go to that of the identification of the type of moves. What is that type of moves? I showed you in the time frame that 0030 to 7:30 is the Japanese session, and which is further divided into early, mid, and the late session. So when the forecast says, the forecast says that dip and then rise. That means what happens? They make the dip during the early session from 0030 to 2 GMT. Then the mid session slowly they start gaining the level from 2 to 5 GMT, 2 to 6 GMT. Then 6 to 7:30 GMT, they start gaining the level or dropping the level. So now today's scenario, they just made the dip and started gaining during that of the Japanese session. And here, during that of the European session, between 8 and 9 GMT, they are expected to gain the level and start making the slide. So here you find they are expected to make the swing and then slide. So high level swing and firm up to confuse the traders and build a sell position, start making the slide. Now GBP, we have got that fill. $1.2938 has become a position. Now they have come up to 50. We have the 58 as the order to limit the risk. So we are not taking unlimited risk. We are only keeping 30 pips away the hedge order. So we don't straight away take the market position, because when you try to take the market position, what happens? The platform providers invariably give slippage. Instead, if we keep this order, then if the order is being filled, then you avoid the slippage constraint. So always keep closer to that of the market. A buy limit order, they will fill it, thereby your entry will be an improved entry, and that will help you to enhance the profit. There are two important things which you need to follow, that they make specific type of moves on a daily basis, but still we look into the chart and get confused, and we do not know what way they are expected to make. We focus on the candle, but the players focus on the type of moves. So if you read them using their language, then we'll be able to read their intention. Instead, if they are talking in one language, you try to understand using another language, then automatically there will be a misunderstanding of their conversations. So invariably, you think that they are trying to buy more position, but actually they are holding and building sell positions. That's what happens. That is why you find that many of the occasions when we have followed the chart and blindly taken the positions are being stopped out. Now, They make specific type of moves in the market, and if we follow those type of moves, we'll be able to read their intentions very well within the session and within the day or within the week, in what way they are going to make the moves. That can be done by understanding the type of moves they are doing it in the market. Now, what are the type of moves they do it? They make three categories of moves. One is less than 30 minutes as quick move. All quick moves are false moves in the market. They will quickly make a move as if the high is going to break and endlessly it could rise. That's how they will create the fear. Then later on you find that they start offloading more and more positions. So they make the fear creating move as a quick moves. They are as stop and false move. What is the difference between stop and false move? A stop is the one above that of the initial high. They go about 10 to 15 pips or 23 pips and then come below that of the initial high less than 30 minutes. That is referred as stop. Then what is false move? It is again a move happening in less than 30 minutes. What they do is, from that of the high, they quickly gain the level up to that of the new high without breaching it, drop. So they pretend as if they are going to rise and then subsequently they drop. Because only when they pretend, the traders will become emotional and they go in for short covering or long liquidation. So they have to quickly rise or quickly drop. In a quickly rising market, people will try to buy, thinking that they are jumping into that of the running bus. Then later on, they find that by the time they enter into that of the train or the bus, it has already reached the destination. Afterwards, it is not making any further rise. And if they hold for some more time the position, then the market started sliding. This is what happens for many of the traders to their surprise. So a false move is the one, they move up to that of the new high or the initial high and then reverse, or to that of the initial low and reverse the market quickly and breach the opposite side and continue to move. This they do it during that of the gap time and also before that of the data release time. Then you come across another move which happens for more than 30 minutes up to 2 hours. When they are making a high level consolidation like this, they quickly breach the high and go above and stay there and continue to hold for about 30 minutes to 2 hours and build sell positions. Afterwards start making the slide. And that is referred as extended move. And this extended move happens for more than 30 minutes, whereas stop and false move happens for less than 30 minutes. Then up to 2 hours. So 30 minutes to 2 hours, they try to hold high and induce the traders to become bullish and freely sell it to them. And traders will be waiting for the market to go higher based on the technical study, and later on they find that the market is making slow slide. Then they go in for an averaging in order to exit out of the position with a bullish feel. Then the players continue to drop, and those who have taken more positions find that the usable margin is eroding because all the positions are negative. Then automatically they start cutting the positions. This is what happens in the market whenever the traders think that beyond their capacity they can hold positions. If they don't take calculated risk, then they could get margin call during that time. Whenever they make such quick moves, the traders become stunned. They do not know what to do. And at that time, the players simply apply the margin call by making whips or moves. Then another true move they do is the intentional move. which indicates the true intention of the player. So they make a quick upward stop and slowly, pip by pip, started making the slide. So what is the actual intention? They make an upward stop so that anybody holding sell positions should not make profit, and they hit their stops and earn money. Then subsequently slowly slide the market. At that time, there is no short seller to book profit, and the traders think that in a bullish market, dips or buy opportunity, they buy, and later on see that they drop for 2 sessions. And when they make about 100 pips or 75 pips drop, the traders turn bearish. Immediately they cut the positions. At that time, the players buy such positions, start making the rise again. So basically, the players are here to fool the traders and earn. So if you continue to become foolish every time during such quick moves, then that means we are real fool. Because normally a wise man avoid repeating the mistakes. Who will repeat the mistakes? Only foolish people will repeat the mistake. But in the market, if you see, we make so many mistakes and lose money. That means we are foolish. Without understanding their intentions, we try to follow the market. We pretend as if we are the best reader of the market and try to read. And once we lose the money, we cut sorry. And instead, because of ego, we don't accept that we have made a wrong decision. Instead, we say that the market is crazy. It was supposed to rise and suddenly it has made the drop. So that is what we try to put the blame on the market rather than putting the blame on ourselves. So that is the intentional move. The intentional move, what happens? It happens for 2 sessions and the start of the 3rd session. So they continue to cut the low and continue to drop again and again for 2 sessions, and the early part of the 3rd session they just do it and reverse the market. And normally they don't do hat trick. That means they don't make similar moves for more than 2 times. So 3rd time they will pretend as if they are going to do the downward move and reverse and start rising the market. So at that time, if you buy, you'll be able to quickly book profit. So this is how we should read their intentions and understand it. See, GBP about 5-15 minutes back, how aggressively they have been making the gain, as if it is going to touch the heaven. But afterwards, slowly they are selling. The red means they are selling. Then swing is the type of move which happens between the high and the low, or near that of the high or near that of the low for about 10 to 15 pips. That is more of a consolidation without breaching the high or the low. They just make small up and down move and indicate that the market is live. It is not dead. So that the traders find that, okay, market might wait for a trigger to happen and then it could make the move. Before that, the traders will try to take positions. You got any doubt? Kindly ask me. So our trading strategy is we note down the initial lows and the highs and find out whether they are doing the stop and above that of the initial high or below that of the initial low. If it is a stop and during the early part or the late part of the session, we try to buy during the downward stop and or sell during the upward stop and then we wait for the market to reverse and show the profit. Once the profit is shown, we try to keep stop at entry. As soon as we enter, we keep 30 pips away the hedge order. And once a position makes about 15-20 pips profit, we keep stop at entry and remove the hedge order. At that place, the hedging is used instead of stop. Then later on, when the position makes further profit, we try to use the trailing stop in a profit making positions. So as soon as the position is taken, we use the hedge order to limit the risk. And once the position makes profit, we keep stop at entry and trail the stop in order to maximize the profit. This is the basic trading strategy we follow. So we keep the hedge order 30 pips away from that of the market and away from that of the original entry. Then in the event, if the market hits our take profit order, or if the market is able to reach our target and then we are able to close manually, fine, the trade is closed with a profit. In the event, if the market goes against, because we have to think of either way moves of the market. Market can suddenly change the direction, and depending upon the market trigger, at that time, if the position is hedged, then we have to wait for 10 to 30 minutes. If the hedging position is not making profit for 30 minutes, so we have the order. Now this is the GBP buy position. We have the hedge order at 1.2958. Market has not gone up to that. But if the market has gone up to that, then it is filled. And if the hedging is not making profit for 30 minutes, then we understand it was filled during a brief upward stop. And then it continues to make loss for 30 minutes. Then immediately we cut the buy stop with 2-3 pips loss and keep another hedge order 15-20 pips away. So the position is not making profit for 30 minutes. Then we cut the hedge order, hedge position, and keep another hedge order 30 pips away and limit the risk. Now, if the hedge is not making profit, if the hedge is making profit and loss alternatively for 30 minutes, then keep stop at entry in the hedge. And once the hedge is closed without any loss, keep 30 pips away another hedge order. Then once the market start making the move in our favor and the position start making profit, we keep stop at entry and remove the hedge order. The third scenario, if the position is hedge is making profit, that means market is exactly moving away from us, against us. So the hedging is making profit, the original sell side is making loss. Then what do we have to do? Keep stop at entry in the hedge order, hedge position. Let them rise the market even 100-200 pips away from us. Then afterwards, once it comes down and hit our stop at entry, we can just wait for the market to make another 30 pips drop and close the sell position as well, or with a profit. So there what we do is, we use the hedge to limit the risk, and we allow the market to make any type of move, but ultimately when it makes move in our favor, then we book profit. So that we limit the risk and book profit consistently, and we don't become panic when the market moves away from us. If you're more intelligent, then you do either way trading. If the hedging is making profit, we watch and find out what sort of moves they are doing it. If it is an intentional move or an extended move, we watch for 30 minutes. And if the new low or new high is not being breached for 30 minutes, then we try to book profit in the hedge and keep another hedge order to limit the risk. And later on, when the market moves in our favor, we book profit in the original position also. So that is called either way trading. Both in the hedging as well as the original position, we are able to book profit. Here's a question from Balachandra. Will the euro AUD come down from this high, or it will move higher from here? No, it is expected to come down. Watch that euro stopped cutting the high, started sliding. Australian dollar already showing negative rate change. Both are coming on the downside. So when euro is losing more, also euro Aussie will come down. When Aussie is also losing more, euro Aussie will come down. That is how you have to relate it and understand. No, if you don't read by yourself, instead of asking somebody to read for you, if that somebody reads it wrongly, then you feel bad. It is something like asking somebody to eat when you are hungry. So try to learn the art of trading, art of reading the market, and try to trade with your own insight. That is what my humble advice will be. You can always ask questions, but at one stage, you should be able to read on your own. It is something like, suppose you want to drive a car. Okay, you can keep a driver and ask the driver to drive the car. Later on, you like to learn it. Then you sit in the car, try to learn from that of the driver how to drive the car. Then afterwards, you don't require the driver. You can drive on your own. No, you should develop the self-confidence. Then automatically you are able to drive, and also during driving you are able to talk to somebody who is sitting next to you. You are not really focusing. No, I am going to the second gear, I am going to the third gear, I am just applying the accelerator. Like that, you don't tell anybody. It becomes instantaneous. In the same way, you should be able to trade, you should be able to learn the art of trading and trade on your own. Why I'm telling again and again in my webinars this, because the self-confidence in trading is most vital. And that is the only one which will be able to make you profit. Otherwise, no, the market fear will easily grip you, and you will really find it extremely difficult to earn money from that other market. Any other question? I'll be willing to answer to those questions. So these are all the trades. If there is any question, I am willing to extend the webinar. Otherwise, if there is no question, if you ask anything to be explained, I'll explain it. So basically 3 components: the derived forecast, market reading, and trading. Then the market timings as one component, and with which we are able to apply the forecast and understand what sort of moves they are going to do it, then plan our trade. Then we note down the initial lows and the highs around 3:30 GMT, find out what move they are going to do it in each session, and try to take positions accordingly. Thereby we'll be able to capture swing trade profit. Then during that time, we identify what sort of moves they are doing it in the market, and that will help us to make money. If you understand well the type of moves, then you find you are able to make money like a child's play. Use the hedge to limit the risk, and in the event if the market goes against, don't become perturbed. And if it is hedged, you see that hedging is making profit or loss. If it is making loss, you close it. If it is making profit, keep stop at entry and watch the market to move in the direction. Then it will start reversing after 1 or 2 days, especially in the case of Euro and GBP. But in the case of crosses, the reversal might take about a week or 2 weeks. You have to patiently wait. then you'll be able to book profit in your trade. If you take only one position at a given time and wait for to book profit in that and then think of another trade, you'll be able to really earn money from that other market. Consistently, profit will come up. So only one is filled. The euro and yen, they are not yet filled. So I'll watch for them to be filled. If you ask any question, I'm willing to answer those questions. Otherwise, I'll try to wind up the webinar so that I'll come back by 13 GMT and show the results. So no question is coming. So I take this opportunity to thank FX Trade for the facilities provided. And please track the trades what I recommended and try to see how exactly you are able to understand the type of moves the players are making in the market in relation to that of the time frame, and see that you learn the art of trading. I'll come back during the part 2 of the webinar by 13 GMT and show the results of the trades what I recommended and explain to you further how exactly we'll be able to trade at ease. Wish you all the best in your trades.